Well, today's non-farm payroll report absolutely blew the Wizards of Smart out of the water, with 467 jobs estimated to have been added, and that wasn't the end of the bombshell news, considering I believe there was an expectation for only like 130 to be added, and most people were saying, well, actually, we're going to lose jobs this month. ADP showed that there was a loss of 300,000 jobs, and the whisper number, according to CNBC, now is it really a whisper number if CNBC is talking about it? That aside, they were saying it could be as bad as negative 400,000. Instead, it was over 400,000 positive, meaning we added 467,000 jobs, according to the Department of Labor, or Bureau of Labor Statistics, sorry. Now, in addition, they revised back a bunch of months last year, which, I mean, it's almost cartoonish. They doubled some of them. They added in just hundreds of thousands of jobs to the previous non-farm payroll reports. I don't know what to make of all that. You know, I do have a tendency to just assume that ADP is always wrong, because ADP tends to not match the non-farm payroll report. But did it really miss by like 750,000? That's huge. Is ADP that wrong, or is the BLS just lying to us? I don't want to just come out and blatantly say, with no evidence, that they're lying to us. But would it shock me? No. They certainly have ways of manipulating the unemployment rate to where it's effectively a lie. But I've not seen evidence that they outright lie about the numbers themselves. They just interpret them in a way to make them seem much more favorable to the government than they actually are. But whether or not the non-farm payroll report is accurate or not, whether or not we actually added 467,000 jobs in the month of January, and if we actually, added all of these hundreds of thousands of jobs that they're now saying that we added last year, that's irrelevant, because the NFP is going to be believed by people, and people are going to trade based off of the NFP. And so what happened when this number printed? Bonds went to the moon. Treasuries, in the short term. By that I mean short-term interest rates are rising. Why? Well, because now it's almost certain, with this good of a jobs report, the Fed has all the excuse they need to raise rates in March. It's pretty much a certainty at this point. If this was a bad jobs report, if the NFP was as bad as the ADP the ADP jobs report, the private payrolls report, which was down 300,000, the Fed it would be very difficult for the Fed to come out and hike rates. Even though they've said they'd do it in the past, if we have all this bad economic data, it's going to be tough for the Fed to raise rates, which Wall Street does not want to see happen. So this great economic news is terrible for Wall Street. They don't want the Fed to fight inflation, because in order for the Fed to fight inflation, they look at that as the Fed fighting them. Because when you look at Wall Street and you look at asset prices relative to the overall economy, what do you see? You see a big fat bubble. You see tons and tons of inflation. Inflation that's been building in asset prices for over a decade, which, the Fed did on purpose. That was their intention. The Fed's intention was, hey, if we inflate asset prices, people will feel richer, they'll go out and spend money, and we'll get, a short-term boost to GDP numbers. Does that mean that the economy is healthier, the economy is better? No, but it looks good on paper, and so we want to incentivize people to go out and blow their whole paycheck. The theory being, hey, if I look and I see my 401k is appreciating rather quickly, well, then I feel more confident spending more of my current income and not saving as much. And remember, GDP is not a measure of economic health. It's not a measure of whether the economy is growing in any sustainable way. All it is a measure of how much people are spending. They just want you to consume. That's why everything that you read, everything that you see, everything that you're told, it's all there exists to program you to consume to boost GDP. GDP is it's a gamified number. That's all it is. It's a high score for how much money can you blow in a single month or a single year? You're going to act differently when you're trying to maximize GDP rather than maximize the health of the economy. And so it would seem that the Fed has finally been effective in getting people to spend lots of money. People are doing that. People have the money to spend, they're going out and they're buying things, and they're buying so much stuff that they're driving up the price of goods rapidly. That appears to be what's happening. Now, the counter argument to that is that this is still just supply chain shocks, i.e. people aren't consuming more than they normally would. It's just that the economy, because of the shock from the shutdowns or whatever, it has not caught up with all the orders and all the consumption, and so businesses are just trying to catch up with demand. And so therefore, the inflation that we're seeing is transitory. That was the whole transitory inflation argument, which has largely been abandoned at this point. Now, since the Fed has a tendency to be wrong about almost everything, now that they are abandoning the transitory argument, that's when I start to think, okay, well, maybe the transitory argument will have some merit. That's when I have to start considering, these people are always behind the ball. If they're giving up on saying inflation's going to end, well, maybe it will. And that's not based in anything really scientific. That's just my instinct. My instinct is that the Fed has a tendency to always lie and to obfuscate the truth and try to distract people. But then again, they barely acknowledge that inflation exists at all. So maybe I'm reading way too much into it. But nonetheless, this non-farm payroll report, a print of, an addition of 467,000 jobs, what that does is it bolsters the case for the Fed hiking rates. Now, is the Fed hiking rates 25 basis points going to do anything to fight inflation? If we really are suffering from price increases as a result of monetary inflation and of money production, no. A 0.25%, 0.25% increase in short-term interest rates is not going to put a dent in inflation. The way that you stop inflation in this kind of situation is you have to incentivize people to stop spending money. You have to incentivize savings. And the way that Paul Volcker did this, the great, the only good Fed chairman who ever lived, Paul Volcker, a great hero in American economic history. What he had to do was raise interest rates higher than the rate of inflation. Because what that did was it told people, hey, I'm better off saving my money rather than spending it now. If I save my money, I'll have more money next year than if I were to spend it today. You see what he did there? Right now in America, we have negative interest rates, which means if you're saving your money, you're losing money. If you have $100 and we have 7% inflation, you can spend that $100 today and get $100 worth of goods, or you can spend that $100 a year from now and get $93 worth of goods. If you spend that $100 2 years from now, you get even less. So you're a dummy if you save any of your money. Every week when you get paid, you have to go out and spend every penny of it, or else you're going to be losing purchasing power. That's the reality of 7% inflation when you have 0% interest rates. But let's say interest rates were 10% and inflation is 7%. Well, then, a rational consumer might say, you know what, I don't really need a new TV right now. And if I put my money in the bank, or if I go out and buy a U.S. government bond, I can earn 3% on my money. Or I can earn 10% on my money. Now, I can't remember. Did I say that correctly? What I'm trying to get at is a 3% real rate of interest. I don't know if at the beginning if I said 10% or 3%, but let me start over. If you got 7% inflation and you've got a 10% interest rate that you can earn on your money, on net, if you were to save your money, you'll earn 3%. Or you can spend your money today. You spend that $100 on, I don't know, a new hard drive for your computer, or a graphics card, although I guess you probably can't buy a graphics card for anywhere near $100 these days. They're probably a couple $100 for, a normal graphics card. But anyway, my point is, if you spend your money now, you don't make any money on that. It's just you spend it, you got $100 worth of goods, that's it. But if you save it for a year, and there's a 10% interest rate with 7% inflation, well, then you can make, you'll have $103 to spend next year. And so by people, if people are incentivized to save, people will be spending less money. There will be less demand for present goods. There'll be demand for future goods, not present goods. And that's good because that gives the economy time to produce those goods. Because if everyone wants to buy everything right now, there's only so much that can be produced at any given moment in time. And so there's not enough for everybody to spend their entire paycheck every week. There's not enough goods for that in the economy. And so the result is prices must rise in order to rationally allocate those scarce resources. There's not enough TVs for everyone to buy a TV. There's not enough computers. There's not enough cars. You have to incentivize people to spend their money slowly over time, to save their money today and spend it later. If you're having a problem with inflation, you need to get consumers to defer consumption. And a 0.25% interest rate hike is not going to make a damn bit of difference. Right now, if you put your money in the bank, you get approximately 0% interest. Maybe you get like 0.125%, something, I don't know. But it's about 0%. If the bank goes from giving you 0% to giving you 0.25%, and we've got 7% inflation, you're still losing your money if you put it in the bank and save it. So what idiot is going to save their money? Who's going to be more likely to save rather than spend? It's going to make no difference. I mean, maybe there are some people who are right on the margins, of course. I mean, we believe in marginalism and economics. It's important. Yes, there are some people on the margin who are saying, okay, I'm willing to lose a 5.75% on my money, but or 6.75% of my money, but I don't want to lose 7%. So if they hike interest rates by 0.25% and that person's only losing 6.75%, they'll say, okay, maybe I'll save my money. But that's not going to make a big difference. It's not going to end inflation. Hell, Volcker raised interest rates to 20%, significantly above the rate of inflation. Probably doubled it. I don't remember exactly what the rate of inflation was in 1981 or 1980. I can't remember exactly when it was. Because remember, Volcker was appointed by Carter. He wasn't appointed by Reagan. But Reagan, gave Volcker sort of a free pass and said, no, go ahead. I understand you have to fight inflation. Carter, I don't believe, was as on board. But still, I give both of them credit. So the end result is, if inflation is in fact not transitory, the Fed hiking rates by 25 basis points it's nothing. It's going to make no difference. But it will make a big difference for the stock market because the stock market and asset markets in general cannot handle the withdrawal of any support from the Fed. They need to know that the Fed has their back 100% and will continue to provide ever greater support as the years go by. And so even if the Fed were to simply not continue to increase their level of support, not increase QE, or something of the sort, find some way to appease markets, markets would go down. And so if the Fed is actively withdrawing support, as far as the markets are concerned, people are going to sell. They're going to sell it quick. They're going to say party's over because they know don't fight the Fed. That's what they've all been taught. The Fed says it's time for stocks to go up. Okay, we all buy stocks and we'll all get rich. Well, if the Fed is saying it's time for stocks to go down, you better get out of the pool. That's where we're at. There's a life of carnage ahead if the Fed continues down this path. And while they will almost certainly now in March, once the pain starts to set in and they see that they're having no net impact on inflation, either inflation, it really is transitory and it will start to go down on its own and the Fed will take credit and then they'll say, okay, see, our quarter percent rate hike worked. And so now we can go back to, the pro-Wall Street policies that we've had for over the last decade, or inflation will continue to be bad, and the Fed will say, well, see, we tried hiking rates and that didn't work, so we might as well go back to trying to appease the stock market so that at least we preserve everyone's portfolios. And so that's the situation we're in right now, and it's a very volatile one. So things are going to continue to be rough. It's a rough road for the next 2 months until we get to the impending 25 basis point rate hike. So, with that said, I will see folks back here tomorrow.